Coming off of the President's Day weekend, we have some huge news about the economy as well as the stock market. So we really want to be touching on that and some of the changes to not only the portfolios, but then we're also going to wrap up with some of the tax management and some of the wealth management strategies that can really affect you. So we have a lot to get to. I want to start with number one, economic and stock market risks. Well, what we're really seeing here is that especially Japan and now the UK have both officially entered a recession. Now this is something that they're going to join the likes of China and they're going to join Germany. So we're starting to see more and more countries around the world that are going into a recession. And China has been one of the main ones we've been looking at. But yes, there are other signals that are out there, and that could be challenging for some of the economies and their stock markets, especially the global economy. But what we're starting to witness then is what we call the divergence of the US from many other countries. And we started to witness this trend in 2023, but we're really starting to see a difference now. And this is really because of the growth attributed to the government spending. Now this is something that we got wrong, especially first quarter of last year, 2023, this unprecedented level of spending that the government is going on, and what it's doing is acting as a stimulus. So yes, we have talked for a long time the fact that the interest rates should be correcting some of this, but they're really not. And so what's going on now is that we thought, well, that we would be in a recession in 2023, and we've been able to skirt that just because of the stimulus that we're putting into our system just from our country alone. Now that's different from the other countries. So whether it is Germany, whether it is the UK, they're not doing this in the same manner. But what we also start to see is that even though we were wrong on the US for last year, we were actually correct with some of these other countries that are going into a recession, and especially because they are not spending on the stimulus plans the way that we are here. So what that means then is that all of this spending that's really happening, that our model for all of this, what we call our nowcast model, is starting to increase the growth rates and expectations for this year. So while we accurately predicted, well, a lot of elements of the world, we didn't get the US right. But one that we did get right, India. You see, India is really one of those countries that has been on a tear recently with their economy, and they keep accelerating in the growth, and they're leading the G20 in real growth. So that's another place that we continue to keep looking for and really understanding that they can be a driver of world growth as well. So another element that we really are anticipating is the fact that China, Germany, the UK, while they're in a recession now, they most likely will be coming out of that probably after the first half of this year. So that could be another element for growth coming up on the second half, the back half of this year. And that could actually have some really interesting times for the stock markets around the world coming into a time of, well, seasonally good times with the markets. But what we also are witnessing that we've had a lot of the stimulus plans that may actually continue through the year and actually increase as we get closer to the election time. And if that's the case, we have a lot to look forward to with respect to potential growth in our economy. I want to take a moment to talk about number two, portfolio changes. Now what I mean here is that with all of the different dynamics of the economies around the world, what we're starting to see is that, well, the US dollar is strengthening against other currencies. And why this is really working for a portfolio change is the fact that we can be invested into the US dollar against other currencies, and what that would do then is be a little bit more of a safe haven. You see, US bonds have not been performing well. International bonds have not been performing very well. And so we need another element to really avert some risk. And that could be potentially the US dollar. So that's where we're seeing some really good growth potential happening out there, and some security that they could provide as well. So with the portfolios, those are some strategic changes that we can continue to keep looking at as part of the overall portfolio itself. So again, there's a lot of elements that are going here, but one thing that we can be doing is looking for strength. And right now, there's strength in the US dollar. Along with the US dollar and many different elements of the global economy, there's one thing that we can be focused on this time, and that is number 3, wealth management and advanced planning. Now, like I said, one of the elements here that's on your mind probably are taxes. And I want to let you know that there are many different ways we can be working with taxes, especially a significant and important element when it comes to your investments. Now, what we look at here are what we call after-tax returns. And this is something that you may not really have done much in the past with, but it's a huge strategy and opportunity for moving forward to hopefully save in taxes, but to avoid paying them possibly altogether. So what is important here is what we focus on and how to optimize them. And there's a number of different ways that we can be looking to do that. So I want to give you 10 just for you to consider. First one that is out there, tax loss harvesting. Now what this does is really say we can be cutting the losers and we can use some of those really losses to offset any gains that we have. But we also have the ability to defer gains. So it's another strategy, and potentially maybe even passing them off to your heirs where we can get a step up in basis. So there's many different opportunities there. Then we take a look at tax exempt securities, tax advantaged accounts, and where we call asset location. So what we work with here is saying we want the correct investment in the correct account. And so it may not be helpful to have something that avoids taxes in an IRA account that already is tax deferred. But if we put some of those into non-retirement accounts, we may actually have very good benefits. On the other hand, it may be worth it to put something that pays out a lot of dividends and is highly taxable on those dividends into a retirement account where those dividends don't get paid out and taxed in the same exact way. So the location of them is important as well. Then we take a look at short-term gains and really avoiding mutual funds. You see, mutual funds pay out those gains every year. They pay out short-term, long-term gains, dividends, all of those things, while other investments may not. And so that's where we can take a look at some of the different ones that are going to be right for you. Well, then we also look at tax efficient credits that we can be working with, education planning, and how to utilize gifting. And what we're starting to see is that when we look at all the different things that we can be focused on here, gifting is one of them, but then also the different investments, now we can start to see of how when worked together, the different investments that we can be focused on this year match with the locations that they're in, as well as some of the different elements of tax loss harvesting and avoiding taking some of the gains. Well, now we can see of how that has a very big potential of saving in taxes and hopefully enhancing your after-tax return. So by doing all of this with the right strategies, reducing the taxes that you pay, now we have a good wealth management plan. And if done well and done correctly, we could find really significant savings here. So this could be, for some of you, 50% tax savings. And I've actually had some clients that have really paid zero in tax just because of some of these strategies. Now, I'm not saying that's going to happen to you, but what I am saying is that there are the potentials out there. And it's just a matter of finding all the after-tax returns correctly. Now, as you're thinking about that, I want to talk about number 4, our second opinion service. Now, what this is just a friendly reminder to you that you, maybe your colleagues, your family, you have the ability to have a second opinion on your wealth plan. And what this is going to do is take a look at where you're at today, where you want to go in the future, and then see if there's any gaps that exist. And if there are gaps in your wealth plan, the best and correct strategies on how to really close those gaps. That's what the second opinion service is. And it's really just this. stress testing your plan to see if it cracks. And if it does, fixing it. So if you really want to be going through this or know someone that does, feel free to reach out. We'd be happy to not only talk through this with you, but set a time that we could be going through the second opinion for you, your loved ones, or even your colleagues. So with that, we've talked a lot already today about not only the changing of the world economies, investments, taxes. Feel free to reach out if you have questions. We are here to help. Take care.